The market is volatile. I don't know how else to say it. With all the news that is circling from Russia and Ukraine, inflation and recession, banks collapsing, interest rates, job cuts, and so much more, it's easy to see why. Our human nature is to hold on to what we have. We're gatherers by nature. The problem is this mentality can lead to many problems when investing, as the decisions that you make are around not losing money and making poor investment decisions nonetheless. Today, I want to discuss 4 key things that if you'll keep in mind, and it will keep you calm and keep investing, and you will win in this volatile market. If you'll stick to these basic principles, I have no doubt you will walk out of this market a champion. Let's jump in.
Welcome to the Financial Mirror. Where future success is reflected in our knowledge of fixing the one thing we can control, ourselves.
Thanks for joining me today on the Financial Mirror as we continue to improve the one thing you can control, yourself. If this is the first time you are joining in, don't forget to hit subscribe on YouTube to be notified of all the new episodes as you release. If you are on whatever podcast platform that you enjoy listening to this on, don't forget to like and subscribe to the podcast on Apple and Spotify. 5-star reviews, written comments go a long way in helping to grow the community and just continue to build more better stewards of personal finances out there. So, this is a great opportunity. I'm glad you found us if you're listening on a podcast, but all the more support, just continue to share this with more and more people. So I wanted to so today's episode is all about investing. It's all about making sure that you're doing those things that are right so that you can win in this volatile market, as you heard in the intro. But real quick, I wanted to say, tax season is coming to an end. So I want to give you your pre-warning because this is coming up very, very soon. So April 18th is the tax filing deadline for the IRS. So go ahead and, if you haven't already, go ahead and finish your taxes. Go ahead and hop on that piece and get that complete. It's not going to get better with time. So go ahead and jump in and knock that out. Also, I hope you got a chance to watch or listen to the marriage series that I did with my wife the last 2 weeks. If you did not, go check it out. We talked about everything from, budgeting as a couple to some talks you need to have before getting into a marriage, or if you're already in a marriage. Hopefully it gives you some eye-opening topics that you can have a conversation with your spouse on, or if you're about to get married, your fiance or whatever. Just to sort of get you in the right mindset when you're having those conversations around finances and your relationship. Because as we discussed in the series, and I don't want to belabor this point because today we're talking about investing, but finances are a huge driving factor of divorces in the country, right? So getting ahead of that and talking about it early is great. So 2 points of view in that episode, me and my wife. You get to hear both. You get to hear how we've sort of navigated and talked about it. So go check it out if you haven't. And also, I want you to know that coming up in the next series is a Increase Your Net Worth series. So that'll be coming up, and I hope that you are looking forward to that. And so don't forget to continue to tune in so you can see when that drops. It's going to be a great series. It really is. It's all about you being able to increase your net worth while, doing all of these things that we go over from a financial perspective. But I wanted to take a moment just today. There are a lot of big things happening at the Financial Mirror, and I'm so happy to have you along the journey, and appreciate the support over the past few years of growing this. And it's really, really been an amazing experience, and I've enjoyed it. So thank you so much. Thank you for all those that reach out and talk about how much this is helping you or how much you enjoyed listening to the stream. So, much appreciated. But let's jump in. So volatility is not going anywhere anytime soon. Okay. Volatility is not going anywhere anytime soon. And I'm saying that for the simple fact that we have a market that is going up and down. If you heard me at the beginning, you heard me talk about how the market is being influenced by all these other things, right? Like you've got every single thing that happens, there's an influence by everything, right? Everything is being influenced by something else. So the market is being influenced by all these outside factors. Now, why? Like what is that? Like why? How can all these factors influence a market? Well, it's just like anything else. When everything is going good, you're going to get a lot of people jumping on, right? Like let's think back. The most recent example is like COVID, right? The market had like in 2 months had just collapsed, right? In 2 months. And then all of a sudden, all of this money started coming. People are like, oh, like we're rebounding. We're getting all the government stepping in. We're doing all these things. We're getting like, this is rebounding. We hit a bottom. And then all of a sudden, boom, explodes. What happened along that whole entire explosion? People were jumping on, right? Like people were not wanting to miss out, FOMO, fear of missing out. They wanted to, let me get my money in there. And then it grew. Some people stuck around. Some people, that was just a quick buck and they moved on. For others, they stuck around and they tried to continue to invest. Well, now over the past, however many 18 months ish of this like up and down volatility market, people are jumping off. People are like literally jumping off of this thing. And so the more that jump off, the more the market becomes volatile because you got people are like, oh, well, now this is its new bottom. And then you get some more people to jump on and then boom, it collapses again. Like, oh no, now this is, and it's a constant investing game of like people like jumping on and off the thing. Dave Ramsey always says the only people that lose, the only people that get hurt on a roller coaster are those that jump off. And I think that that's a great example of investing, right? Like you're going to get hurt. You're going to get smoked if you jump off the roller coaster. If you jump out of the what are they called, cabooses? Like, I don't know, like little like carts maybe. If you jump out of the roller coaster cart, we'll go with that, you will get hurt if the ride is going on. So just stick along the ride. And that's what this whole episode is about. It's just sticking in with the investing, with the volatility, because there's so much going on. People are unsure. That leaves them on the fence. They're like bullish, they're bearish, it's all over the place. But if you will stick to it, you will win. So I want to go over real quick, just 4 simple points. And I'm telling you, like, I'm going to say these and you're going to be like, dude, you have said that 1,000 times, but I think it's necessary. And I'm going to tell you why I think it's necessary, because so many people are reaching out and asking about investing. So many people are reaching out and asking about, what should I do next? Right? Like that is what a lot of people like. The market's up and down. Like, what should I be doing right now? And when more and more people are asking that, I can see the hesitancy in the mindset. Like you're not sure, am I doing the right thing or am I not? And if you remember what I said at the intro, is we are gatherers by nature. We want to have resources, whatever that resource is, that is currency, right? Like it could have been like back in the day, it could have been land, it could have been food, it could have been like all these things. And now this like currency that we operate on is money, right? It's money. And when we start to lose that and we see it just going away, it's hard to just continue to watch it bleed and watch it go and watch it disappear. So I think it's necessary for those reasons, because I want you to remember that this is a long-term game. Right. And so if I can hit you with these 4 topics and I can hit you with them and just remind you of them, I hope that this will go a long ways in just keeping you in that right mindset, because it can get difficult. It can get absolutely difficult to continue to watch markets fluctuate the way they are and watch your money disappear. It can, but you got to remember the long term. So let's start off with number 1. The first thing that I want to tell you is you've got to keep your risk in mind. You've got to match your risk to your current goals. Now, how do you do this? Well, the markets are swinging back and forth. They're going to go up and down. They're going to do all of these things. Now, the thing to keep in mind is that the only thing that you can control is how much you are risking in this said volatile market, right? So if I throw $1 million out there, I'm risking $1 million. right? Unless I have some stop loss in there, let's just say I lose it all, I'm risking $1 million. If I throw out there $10, I'm losing $10. Now, depending on your time horizon, that depends on how much you should be risking, right? So those with a long time horizon, like your ages 0 to 30, like you've got a long time horizon, you can take on a little bit more risk at this time with all of the volatility going on, right? Because you have that time horizon to build this back up. If you have a shorter time horizon, like you are about to retire in the next 5 years, you should be decreasing the amount of risk that you're taking on, because you kind of want to hold on to what you have. Now, I say that to say this also, that you need to look at your account. You need to look at your account and remember that this account is going to grow. So before I start saying, oh, you have a shorter time horizon, you need to move all this money from these mutual funds over to CDs or bonds. I'm not saying that. What I'm saying though is that if you are right now putting additional money into investments, you should start to look at a little bit of a lower risk option. Now, for your current allocations, I would tell you to go talk to a financial advisor and get financial advice. I'm not a financial advisor, and everything I say is used for educational purposes, just going off histories of the market. But if you need specific financial advice for your account and how you need to manage that, I can coach you through principles, but I'm not going to advise you on exactly what to buy and where to move money. Dave Ramsey has SmartVestor Pros that allow that. They can help you with that. But I stick to coaching specifically. So remember that match your risk to your goals. If your goal is to retire in 5 years, you need to match your risk to that. If your goal is to retire in 30 years, you can match your risk to that. This example on the screen just shows you how someone that is in that wealth building, phase of their life, 18 to 45, they can take on a little bit more risk, right? As they get a little older, they can take on a little bit more risk. And then all of a sudden they need to start decreasing risk to compensate for their shorter time horizon at that point. So that's number one. You need to match your risk to your goals. Number two, and this is the most important piece, you've got to stay invested. You've got to stay invested. Don't get timid right now. Like with all of the news, with all of the market swings, with all of this stuff going on, don't get timid. Don't start to think, well, I've invested all this money, or my account last year was $1 million and now it's only 800,000 or whatever. Like, I don't know what your situation looks like, but don't get timid right now. You've got to stay invested. You've got to consistently be putting money into the market, because you got to remember, the market is all about consistency. If you will continue to put money in there, you will continue to see your money grow over time. Not saying tomorrow, not saying next year, but over time, over that time horizon that you had, you're going to see your money grow. So this is just a visual example, and I'm going to try to walk through it because I think it's very important. But the power of starting early, we all have heard compound interest. We've all talked about it. But what this shows is that you have someone that contributed $6,000 a year to a retirement account that earned a 7% return, which is fairly low actually for a return. Waiting just 5 years, right? So starting $6,000 investments at age 25 instead of waiting 5 years to age 30 cost the individual almost $500,000, right? So $6,000 a year over 5 years. So a $30,000 difference in contribution cost the individual $500,000. And I don't know how else to visually explain this. Like, it's mind-blowing, and people choose to wait. People choose to wait. I can't do $6,000. So do 600. man, I can't do 600. So do 60. Like I don't get the mindset why, like, it's like I call it, so I've talked about this over the past few days with people at work and people, um, uh, that are doing the whole investment thing, and working and trying to do like different things all at once and having trouble like managing it. Um, but I call it the podcast phenomenon, right? And I say this because it's something that I struggle with, and so I put a name on it. You got to know your own beast, man. This is my beast. So the beast is that if I can't sit down and listen to a whole podcast start to finish, I'm like, man, I don't. There's no point in me even starting it, right? Like if I can't start the podcast and finish the podcast, there's no point in me even starting it. And I think that's a terrible mindset, right? I think it's a terrible mindset because of the simple fact that you can always hit pause, right? You can always stop. But I always struggle with that. And so I see that a lot with investing as well. Well, I can't invest $1,000. So why not just invest 50? Like, why not invest $20? Like, I don't know what that number is for you, but you've got to remember it's all about consistency. It's all about continuing to grow your money. It has nothing to do with the amount. Obviously, more money will become more in the end, but that's not what it's really about. In all honesty, that's not what it's about, because someone that waits is going to end up having less than someone that started early. And I know this because people that wait, they struggle building that muscle. Investing, saving, controlling spending, all of those things are muscles. You got to grow them. You got to get stronger on them. This is just one of them, but you got to stay invested. You can't time the market. Don't sell all the news that's going on. Don't be that person. Stay invested, invest consistently. You will become wealthy. The next one, number 3. So number 2 was stay invested. Number 3 is you've got to have cash set aside for emergencies. When you are investing, you are taking on risk. You shouldn't be saving for your house down payment in your brokerage account. It's not going to work out for you most of the time. I'm not going to say all the time, but most of the time. But remember that you need 3 to 6 months of expenses set aside for emergencies, right? This little image I thought was funny. If you know the little SpongeBob kid, little kid that's got his SpongeBob pajamas on, and he's got his face, and he's like, man, my mom made me wear this or something. I don't really know what the face is for, but it's a very interesting face. But all in all, I made a little meme with it, and it says, when you finally get a fully funded emergency fund, then the check engine light comes on. So I think that kind of highlights exactly what it is that we're worried about here. But that's kind of the piece of it, is you've got to have money set aside. You've got to let your investments grow, but you can't all of a sudden start to feel like that if I don't pull this money out of this investment, I can't pay my bills, right? Like, you don't want to get to that point. You don't want to ever have to pull money out of your investment accounts or to pay your bills. I've gotten asked this numerous times, but I want to just highlight it. You should not be pulling money out of your investment or retirement accounts for debt. Man, I've got a dry throat. Goodness gracious. I have sipped water 3 times and I have a dry throat. But you shouldn't do it. You shouldn't be pulling money out for debt. So I keep having people ask me this. It's never a good idea, but get your savings built up and then start to max out your retirement. That's the key here. Get the savings built up, then max out the retirement. Don't try to do both at once. Get the savings built up, then max out the retirement. You will be better off that way. You will have more wealth building capacity when you do it that way. So follow that, because you don't want an emergency to derail your investments. You don't want an emergency to derail your retirement. You don't want an emergency to throw you back in time on how you're doing financially. Okay? So keep that in mind. Get the emergency fund built up so that you have it. And I think that it's a necessary thing, because of the simple fact that, like for instance, like for us, we were going, I don't know if I talked about this or not, but we were flying out to go to a wedding, and all of a sudden our flight got canceled, and we showed up to the airport already and it was canceled. And so we came back home because we rebooked, and our next flight wasn't for a few hours. We came back home and the house was freezing cold, and looked at the air thing. It's like 60 degrees or something, like 59 or something like that. And I'm like, holy smokes, like it's cold in here. Furnace has gone out. Gas furnace had gone out. So guess what that means for us? That's like an $11,000 bill, right? Like that's a huge bill. You've got to be ready for that. I didn't know the gas furnace was going to go out, but think about had I not had an emergency fund and the gas furnace went out. 11 grand. Am I going to like we're going to be walking around the house in Snuggies? Like I'm not really sure what we're going to do here, but like that changes the whole trajectory of your finances. If your gas furnace goes out, and obviously we're not just replacing the gas furnace, we're replacing the whole unit. But I didn't want anyone out there to think that works on gas furnaces that I'm literally just replacing a gas furnace for 11 grand, because I'm sure you were thinking like, man, you are really getting ripped off. I'm sure of it. But that's kind of the thing, right? Is that you got to be ready for those things because you don't know when they're going to hit. But remember to stick to your guns, get the emergency fund built up, and then start investing and get these investments growing. And then number 4 in all of this. So just to recap, number 1 is let your risk tolerance, your risk match your time horizon. Stay invested. Number 2. Number 3 is have that cash set aside for emergencies. And number 4, you got to stay humble. This market's going to humble you, because you'll start to see a little jingle in your pocket, and then all of a sudden, boom, next day it just takes a dump, and it's just red, bear. And that can be tough to look at. It can be tough, especially if you're getting close to retirement and you haven't really, talked to a smart investor pro, or you haven't talked to a financial advisor and really get your finances lined up. But if you are seeing that, maybe stop looking at it. But also remember that when you see it, like that you're a little humbled, like, and you just stay humble, because you've got to believe and have faith that what you're doing is going to work. Don't give up on it. It's got history that comes with how I tell people and educate people on how to do it. There's tons of history that goes with it. So don't think that this is some off the wall thing that's never happened before. We've seen markets way worse than they are right now. So keep that in mind as you're going through things, and remember that this will humble you. But if you're new to investing, and when I say new to investing, I mean like new as in you just started in the past 10 years, you've only felt what it feels like to be in a completely bull market, right? Like it's just been up. Yeah, okay, COVID was a small pullback, but there was an explosion right after it, so I don't really count it. The pullback lasted like 2 months. You haven't seen pullbacks like right now. I'm not saying that's a constant pullback for 18 months, but there's been a like pull, like bear flag, bear pennant type thing going on. Like, and that's the reason why I say, like, I don't really know. Like, are we at a bottom, or is this going to keep pulling back? Like, are we going to break another support level and start going lower? Like, I'm not really sure. But what I can say is that this is a massive pullback for the short time that we've seen, right? And if you look at the last 10 years, this one highlights it's up there with some decent little pullbacks. COVID being a massive one for 2 months. It was just, I mean, two massive red months. But if you know future me, you look at it and you're like, man, that thing recovered. But all in all, like it's really been a tough 18 months. We can say that confidently. So remember to stay humble. Remember to keep investing, and you will win. So investing is a long-term game. It really is. Those that come into the market and they try to make quick money, they do end up finding themselves in, avoiding investing because of the losses that they experience. So don't turn this great. We talked about compound interest. We talked about how your money will grow. Don't let all of that greatness turn you into a poor man's game, right? Because it really, really is a great opportunity to grow your money. So you can see right here on the screen, and if you're not, watching this and you're listening to this on the podcast, you can go pull this up or just search stock market history over the years. But I found this image of the market over the last 100 years. So this is literally the last 100 years of the Dow. And you can see that this is a long-term game. Long-term game. We have been through some pretty massive pullbacks over time. And you can see that it's over time, though, the market has steadily gone up. And that's the reason why I want to challenge you to, fix your risk on your time horizon, to stay invested, to have your emergency fund ready for when things happen, right? You're not trying to think about pulling out of here. And fourth, just stay humble, because this will be a long-term strategy and it will be a long-term game, but in the end you will win if you'll stick to it. So hopefully this gave you a little encouragement, that this built you up just a little bit so that you could see sort of past all the redness, all the news, all the bearishness, all the everything, that you could just see a little bit past that and see that this will work out for you. It's just going to take time. Okay, it's just going to take time. Now, if you are ready to take control of your personal finances, I want you to know that I do personal finance coaching. This is all about getting you and your finances in order so that you can succeed at this life of finances along your financial journey. But I want to be your accountability partner. I want to be the person there to ensure that you're on the right track and that you are getting to the goals you want. To do that, though, let's go over to thefinancialmirror.org and hit book now in the middle of the screen. You'll get to schedule you a free consultation. I said free. Spend about 15 minutes just having a quick chat, video call, just to see if it's something that is going to be beneficial to you. And so I don't waste your time, you don't waste my time, and then we can come together and say, you know what, this will really help you. This is how. So go on over there and see if that's something that I can help you with. Just go schedule the free consultation. And if you do want to give an extra dose of support to the stream, head over to thefinancialmirror.org/shop and pick you up some awesome Financial Mirror gear. I continue to add new things through the season. So go ahead and see if you can find something on there that you want to help support the stream with. And then more importantly, that is a great way to continue to help grow the stream itself and what goes into the content that is created. So I want to say thank you once again for continuing to show up, continuing to listen, continuing to give all the positive encouragement. It's very appreciated. So one way that you can give back just a little bit extra is just to go and leave the 5-star review, go and leave a written comment on the podcast on Apple and Spotify. That 5-star review and the written comments do go a long way in helping grow the stream and continuing to give people just the confidence they need to take on this financial journey that they are on. So I appreciate it. I appreciate you, and I appreciate you tuning in this week. Till next week, continue improving the one thing you can control, yourself. Peace.
Well, that wraps up today's Financial Mirror. Join us next week as we continue to work on ourselves, change our mentality, and to commit to achieving the success we always envisioned. Regardless of your platform, help us grow as a community. Please like, subscribe, and share with the people in your lives.